Hello everyone and welcome. For today's topic, we're going to be talking about amortization schedules. Amortization schedules, as most of you probably know, are what you see on maybe your car payment or your house payment, as long as it's not an ARM. So we'll be discussing what that's like and what differences you see when you change maybe your interest rate or the term of your loan, which is how many years the loan will be for. So let's get into it a little bit. So for me, I just usually Google an amortization schedule calculator. Another place to find it is like Investopedia, or if you want to use Excel, there's great Excel options to use. You can just Google those and find those out. But we're just going to use this basic calculator for now. So right now, the loan amount that I have in here is a $50,000. The interest rate is at 6%. I have the term of the loan at 5 years. Now, you might have some organization fees or documentation fees or just other fees if you're doing like a mortgage. But for this example, we're going to stick to a basic car amortization schedule. So most people have a car loan that's $50,000 or less, so that's why I chose that amount. As we go, you can click the calculate button and it'll come up for you. You can see that your monthly payment would be $966.64. 60 loan payments, that's 12 payments a year for 5 years. That's how we get the amount of payments that there will be. And then you can see the interest that you will be paying throughout the loan. So you have your principal amount, which was $50,000, plus the $7,998.40, and that gives you your $57,998.40. As we scroll down here, you can see here the key part of an amortization schedule, this is the most important part in my opinion. We look here at the beginning balance, we have the interest rate and the principal, and when we add these two together, we'll get this monthly payment amount. Now as we go through this, you'll see that the interest will continue to go down and the principal will continue to go up. And that's how it keeps your payment equal every single month as you're going through and making your payment. That way you can budget appropriately and say, hey, I owe about $967 on my car this month, and I know for the next 5 years I'm going to owe that same amount, so I can budget for it easily. I don't have to worry about paying a principal balance of a different amount every month, and then at the end of the year making a large interest payment on top of that. Because of this structure, interest gets paid directly to the bank and they take their share, and then you make your principal payment, and that principal amount lowers your ending balance. So that's what your new principal is for each month. So it comes over here to the beginning balance of the next month. We have the interest rate, the principal, which again has gone up. The interest rate has gone down, or not, the rate hasn't gone down, but the interest amount has gone down. And again, that gives us a lower ending balance and principal amount each month. So here I have a different example where I changed the loan amount to $350,000. The interest rate stayed at 6% and has a term of 30 years. This example is more of a mortgage example because most people are going to have a loan amount of about $350,000 just based on the national average of new home prices. The interest rate, same thing. The national average as of time of this recording is right around 6%. And the term loan of most people is going to pick a 30-year term. So here we see that the monthly payment will be $2,098.43. You also see down here that 54% of your total amount paid is going to be going to interest. Only 46% is on principal. Now, a couple reasons for that are that the interest rate is at 6%, which is pretty high for current conditions, not in terms of all-time conditions for the mortgage market. But then we also have the term of 30 years, which is a pretty long time to be making payments. So let's look at two things, and this is just a small bit of what we're seeing with the Fed and their quantitative tightening that they're working on. Previously, during 2020, the interest rate was at 3%. So let's look at a 3% interest rate on a 30-year loan and see how these change. Now you can see here that the interest is only 34% of your total payments and the principal is only 66%. More importantly even than that though, look how much lower the monthly payment is now because of that. The monthly payment is $1,475.61. That's compared to almost $2,100 that was previously stated. That really changes the amount of money that people have in their cash flow when they're budgeting. So that really changes how much they're able to make a payment on a house or a car and what they're able to buy throughout the month. Next, let's talk about the different interest and principal amounts. I'm going to move this back up to 6% just because that's what current conditions are. But feel free, if your conditions have changed, to go ahead and look at it at 3%. As we scroll down, you can see that the principal and interest are the two main parts of an amortization schedule, and that's what forms your payment. The interest in this case is very large compared to your principal because it's at the beginning of the loan, which that's when your interest will be the most compared to your principal. As you go and continue to make the payments, that'll slowly change, and at one point, in this example, it'll be around year 18, is whenever you're going to have it that your principal outweighs your interest. Something to pay attention to, though, is how large the principal and interest amounts are in this example, with 6% 30 years. Two things I do want to talk about that I feel are important are making payments early and adding additional money into your principal balance. Number one is making the payments early. Let's say you have $2,100 this month to make your payment. That's great, that's what you need. But let's say you have another $2,100 and you say, I really want to make sure I have enough additional money to pay this off next month, so I'm going to go ahead and give the bank the other $2,100 to make sure that I don't miss a payment ever. That's great. That's a great way to go about things and to just have a good safety net. Another option is to make an additional principal payment. So in that example, you'll have $2,100 for this month, and you'll say, hey, I have an extra $1,000 this month. Let's go ahead and put that extra $1,000 on the principal. Now, something important to note is this will not change your monthly payment. So don't give an extra $1,000 thinking you're going to owe $1,000 less next month, unless that's predetermined with your bank, which that's not typical. But what this will do is it'll allow you to finish making your payments earlier. So for example, if you give another $2,100 in principal over the lifetime of the loan, instead of 360 payments, you'll have 359 payments. There's two schools of thought on this, and I'll leave you with these thoughts to ponder and something that we'll talk about in later videos. But do you want to put the money into your mortgage or do you want to put it into the market? Think about these two things: your interest rate on your loan and inflation, and then what you can get in the market on return. I hope that was helpful for everyone to find out what happens to their amortization schedule when they change the years or the term of the loan, they change their interest rate, and to see why your payment is consistent month in and month out. Don't forget to like, subscribe, and leave a comment below so we can talk about what you guys want to see in this channel. We'll try to feature a comment in one of our videos for next week. We'll catch you later.